The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
If it's Friday, it's about money. And we're talking about money today. We're talking about what's going on in the market. For over 5 years, I've been talking a couple themes, and I added that theme this year as well. But for 5 years, I've been talking about a theme that we're living in a super cycle. That Standard Chartered Bank talked about a super cycle, and those times in which the world GDP grows more rapidly than average. The first super cycle from 1870 to 1913, driven by the industrialization of the United States, that affected the entire world. From 1945 to 1970 was the second super cycle, primarily driven by the rebuilding of Europe after World War II and the Asian countries as well. And the decolonization, when many of the colonies became independent countries. And the third cycle, which began in 2009, driven by the emerging countries. And right now, things don't look so good in those emerging markets. There's a reason for that. And I talked about that for the last few weeks. We're going to talk more about that today. I also want to talk about a time, even though the second theme, where we are in a market where I expect the Dow to be over 100,000 before we see things turn the other way. We are in a time, we've gone through a correction. We'll go through other corrections. We went through a time from 1982 when the Dow was 1,000 to 2000 when it reached 14,000. But it went through correction times as well, 1987, 1991, 1989. All those times were corrections, just like we've gone through as well. I believe we're going to see something happen next year that could be a shock to the system and put us into another correction. I believe that we're almost out of this correction and going on to new highs. But I think next year is going to be a time when there could be a shock to the system. That comes later in the program. But I want to talk about what's going on now. You know, the world is awash in steel. You know, truly awash in steel. Capacity exceeds demand by 600 million tons of production a year. You know, from 2000 to 2015, steel production doubled, but demand didn't double. You know, you can lay in some of the blame on China, at least in part. Their production of steel quadrupled in those 15 years. And probably represents half of the excess capacity. China is exporting 90 million tons of steel a year. It's overwhelming the markets, and they're exporting it at about 10% below what it costs to produce. The Chinese government is pumping in money because the steel producers in that country, those steel producing companies, are losing money. It's a textbook situation like you call in dumping. They're dumping into the market. Wholesale prices are actually down a third. And they're not helped at all by what's going on in Russia with the sanctions that are going on, with the ruble dropping down. Russia's dumping their steel into the market. The whole thing is seeing all this excess steel. I talked a couple weeks ago about the Wal-Mart world. Richard Bernstein, who I've talked about on this program a number of times, that's how he characterizes what's going on. It's a Walmart type world. Walmart, because when Walmart goes into a new market, what they do is they undercut everyone else's price to build their market share. What we're seeing are prices coming down. Steel's a commodity. In commodities, prices have been dropping and continue to drop. Today we saw prices down, and some prices like oil and some of the other commodities down to the lowest level they've been in years. But it's only a symptom. It's not a cause of what's going on. You know, as I mentioned before, this is not the problem, is not the commodity drop in price. It's a symptom, because all these markets, whether it's the commodities, whether it's oil, whether it's gold, whether it's emerging markets, whether it's private equity, whether it's REITs, whether it's junk bonds, all those things are credit related, and we're seeing the burst of the bubble. In the case of China, what happened? We've seen a country in 40 years go from an agricultural base to becoming the second largest economy in the world. It's mercantilism. If you go back and listen to my July 31st, if you listen to the podcast, you'll hear about a comparison I made between what was going on in France in the 1600s under Louis XIV and Jean-Baptiste Colbert, in China. It was the same concept of how to build an economy very, very rapidly. The ruling Communist Party, they control the land, they control most of the economy, they control the military, they own the banks, they control foreign policy, and whatever is major importance to the Chinese government is where they focus their attention. They're willing to lose money on steel because they want the steel capacity to operate. They've adopted some capitalist practice without ever giving up control. They control who gets the loans, who gets the capital, what highways are built, where the infrastructure is built, and if they decide to do something and build infrastructure, the Chinese government can do that, and they don't go through a permitting process. In this country, you can go through years. Keystone Pipeline just got turned down. They've been in the permitting process for 7 years. If the Chinese government had decided they wanted to do something like the Keystone Pipeline, there would not be a delay of 1 month. There wouldn't be a study of 1 month. They would just decide that they needed that. They would implement it. They would fund it. Everything would go forward. But with the Chinese government, if they decide that steel is an important commodity and they want to build a steel capacity, they can do that. If they decide that aviation is important, they can do that. That's what they do. They control all of that. But when the market turns, as it has turned, prices begin to drop, and they need to drop their currency when you have an overcapacity, when the overcapacity exceeds the demand. What do you have to do if you're a country? You have to devalue currency. We saw that happen once in China. I would expect it's going to happen again. But what we're seeing with commodities and junk bond, energy, all these areas, we're seeing a bursting of the credit bubble. A credit bubble that built up over almost 2 decades through the 1990s and 2000s. Now we're seeing that burst, and we're seeing the impact of that. Think about the housing. I think that there's an example of what went on with the housing market. It started with subprime mortgages, but by the time it was over, it extended to all of housing. You saw so many people underwater with their houses. You saw the number of foreclosures going up. That was not a phenomenon that just happened in this country. That spread through Britain and through Europe and through the other areas. It was something that had to take the prices down before prices and demand began to pick up. Oil hit a new low today, and I think like subprime housing was with the housing market, oil has been with commodities. I talked about this going back over a year because I felt that oil was a product that was the price negotiated in the back room. There was a book that was written, The Oil Kings, written about the Kissinger and Nixon years and the Shah of Iran. and the Shah wanted to rebuild the Persian Empire. The Nixon administration thought that the Shah was our closest ally. He controlled what was going on in the Middle East. We put bases there. But the Shah wanted modern weapons as he rebuilt the Persian Empire, and he wanted to buy them from the U.S., most modern equipment. And he needed to sell oil to do it. And Nixon and Kissinger negotiated oil prices and began to increase. It wasn't until there was some pushback, and especially in the Ford administration, that the Shah went to OPEC. And through OPEC, they continued to increase prices. But it all began in the back door, through the backdoor negotiations. I believe that probably happened with oil prices this time. It went through a time when we wanted to put pressure on Russia. Russia, half of their income, government revenues are from oil and gas. And the Arab countries wanted to squeeze ISIS because their main source of income was oil. So by putting pressure on, bringing oil prices down, that began the same thing and had the same impact as the subprime housing market had in bringing on the housing crisis. That began a process, and as it did with housing, I believe it's going to take some time before that's over with. Don't go away, because we're coming to commercial break, and I want to finish up talking about this. I've got a great guest. He's got something to say, and I want to talk about this potential shock coming next year. Don't go away. I'll be right back after the break.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our clients' interests first in all portfolio decisions.
If you're looking for a home for your seven-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I've been talking about this whole thing with credit-related assets, whether it be commodities, whether it be gold, whether it be oil, whether it be steel, whether it be junk bonds, private equity, the emerging market stocks, all these things that have come into play because a credit bubble burst. And I believe that it all started and really came down when oil came down. And I explained, and I've talked about this a few times, about the backdoor negotiations that I believe probably went on to bring the oil price down to impact Russia and ISIS, both of whom depend largely on oil to get their income, their revenues. But I believe that started a cycle that really began to bring things down. Now, it was only a few years ago. That people talked about commodities being another asset class. And financial planners were pumping commodity funds into client portfolios, saying this is an asset class. Look at what's happening with gold. Look at what's happening with sugar. Look at what's happening with steel. Look at all these quantities that are going up. You know? And so you had a tremendous number of people and institutions pumping money into commodities funds. And what happens when you have a limited asset? You begin to push up the price, right? And not only that, a lot of these were derivative contracts. The way commodities are sold. If you go out and buy a gallon of gasoline, put it in your car. That's a cash purchase. But a lot of commodities are sold on a futures market where you're buying something to be delivered in a year or 2 years. Gold was sold that way. The gold miners used to sell a lot of their production into the future. So they would sell gold to be delivered in a year. But as the gold price rose, they began to quit selling the futures prices because the cash price was so much higher than the future price. They began to eliminate their futures contracts and focus just on the current price. But speculators stepped into the market. Speculators step into the oil market. And while there's no real data, people were estimating that of the contracts for oil, over half and up to 70% were speculators, were hedge funds, were commodity funds, speculating that the price of oil was going to go up, buying it at today's price, expecting it to be higher next year. And when you have a contract like that and you don't intend to take delivery, what do you do as you get close to the end of that contract? You sell that contract to somebody and you roll out and you use that money to buy another contract out in the future. And then when that starts to get close, you roll out of that one and you buy another one further into the future. And the more money that's pumped in, the more of these derivative contracts that were sold until the point the prices start to come down. And now, looking out to the future, you see that the price that of the oil a year from now is going to maybe be down. So you begin to sell, you begin to liquidate. And not only that, your investors begin to pull the money out of these funds, and suddenly you have the reverse happening. Instead of money pouring in, you have money pouring out. And prices begin to come down. And for me, that looks like a logical thing of what went on. Now, there's no one that's talking about that. There's no literature that I see that talks about that. But it seems logical to me when you look at the whole scope of things and with the overcapacity that was built, that that's where we are. With a lot of credit available, if you've got a lot of futures contracts and you can, if you're an oil company drilling, an exploration company, you're drilling for oil and you can see that you've got all these future contracts coming up, what do? You drill for more oil because you can get a higher and higher price. You know, being in the business I'm in, managing money for clients, I bet I get 1 to 2 calls a week, cold calls, people asking me to go into oil drilling programs. And it used to be more rapid a year ago. There used to be a real push when I would go to conferences. At conferences, there would be exhibitors in the conference, and I'll bet there were 15 or 20 oil drilling programs you could invest in these conferences. They were trying to get investment advisors to actually sign up to sell their clients these oil drilling programs. Do you know what? I walked by every single one and said, your price is too high. It's what happens if oil is $40 a barrel? What happens if it's 60? You know, I didn't expect it to get to 40, but I wanted to know. Most of them are underwater at that price. Most were underwater at 75, a few underwater at 90, but they were still trying to sell this to unsuspecting investors. And commodities were the hot thing. But when things turned south, that's when you get into the issues we're in today. We've got a lot of extra drilling. You're seeing oil rigs shut down now. We've got a lot of steel mills. A couple steel mills are shutting down in Scotland because of the overcapacity of steel production. I started my career at Intalco Aluminum up in Ferndale, and they're shutting down at least a part of that plant now. Alcoa is shutting that down. Wasn't owned by Alcoa in those days. Is owned by Alcoa today. And because there's an overcapacity of aluminum, they're beginning to shut that plant down. All over the world, we're seeing excess capacity taken out of production to get production supply in line with demand. And it's going to take a while for that to happen. It's going to take a while for things to pick up. And we saw that with the housing market. When we got down in '08 and '09 and '10, when prices were so low, there were still some builders that were building. There were a couple builders that were on this program. We talked about it. They were building homes in the low range, but they were still building homes. There was still some home building going on. The majority of home building had been shut down. And now we're at the point where land hasn't been developed and there's a shortage of homes. But we've seen it pick up. I believe commodities are going to be in the same trend. It's going to take us 4 to 5 years to see things return, and they will return. Maybe not to the prices that they were before because there was a lot of speculation, but they'll return and capacity will come into line with demand. And in the meantime, I think that's going to be good for consumers because the dollar should get stronger. We're going to be able to buy things that are imported at a cheaper price. It's going to be good for manufacturers that are buying products from overseas because prices are cheaper. So I think it's one of those strange times when profits will go up because U.S. companies based here will be able to buy things cheaper. And at the same time, consumers will benefit as well. But I think there's going to be a shock. I think there's a shock coming next year. What impact it has on the market, whether it has any impact or not, whether it's 1, 2, 3, 4 months, I don't know. Overall, I think there are companies that are going to do well past the shock, but I think you need to know the shock that's coming. That's coming later in the program. So don't go away. We've got more to talk about. Before I get to my guest, and you'll want to hear what he has to say, I want to remind you that if you missed these programs or some of these programs, they're on the website. You can hear the podcast. You can go look at the blog, and we blog about a lot of these things. So you can pick that up. You can sign up for the e-letter if you want the e-letter. You should also follow us on Twitter. It's About Money Radio on Twitter. And like us on Facebook. You should go do those things. There's a lot of information there, and it's some of the stuff that is already on the radio, some that's beyond that. So go like us. Go follow us. You can do that. My guest today, we're going to be shifting subjects. We're going to be shifting and talking about one of the industries which has grown tremendously. It's an industry which, 20 years ago, nobody would have believed existed. But it's here, and it creates jobs, and it creates. Somebody said that for every job it eliminates, it creates 1.7 jobs. I don't know. But anyway, before I get into all that, my guest today is Mark Rappaport of Blue Sky Projects. Welcome to the program, Mark.
Thank you for having me.
So let's start with your background.
In the early 1990s, I was a webmaster at Microsoft for Microsoft Exchange and then trained certification, and I did that for a number of years. And I had friends outside of Microsoft who were forming companies and asking for help. And I came to the proverbial fork in the road, and today I have half a dozen full-time developers and another half a dozen specialties beyond that.
Can you hold up a second? Are we getting volume? Okay.
And we do everything from bread and butter informational websites to very custom e-commerce and web applications and now iPhone and Android apps.
So let's talk about some of this. As you got into this, give us some specifics about what all this means. I mean,
the marketing paradigm has changed. Whereas before you'd have a print brochure that you would hand out at trade shows and so forth. There's still a little bit about that, but more and more anytime you meet a prospective customer or you're looking for a supplier, you turn first to the web. And you look up them and you see what their services and or the products are all about. And now it's shifting from desktop websites to mobile. More and more folks are looking to be found, and people are searching first by phone or tablets.
It is something that has really changed. There was a time back in the late 90s or early 2000s when people were talking about the death of brick and mortar. Brick and mortars made an adjustment so that even the brick and mortar have websites.
Yes, no question. More successful ones have blended the two.
And you have to blend the two. We're going to come back and talk more with Mark about what this is, what they do, and what advantages there are after this break. Don't go away. We've got a lot more to go through.
Now we return to About Money. There's more About Money with Mike Adams. We'll resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
They welcome your review. That's adamsfinancialconcepts.com.
6988.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So I'm here with Mark Rappaport. We've been of Blue Sky Projects. We just barely began to talk about what he's doing. You've been doing this for 17 years, right?
Yes.
So your focus is what size of company?
We're pretty broad range, from small mom and pops to medium size, like Daniel's Broilers and Chandler's, to super big companies, Packard Parts and so forth, to name a few.
And what separates the two?
The depth and breadth of the websites and the customization we do. The larger the company, the more unique their needs tend to be.
So let's talk about one of the large ones, and then we'll talk about one of the smaller ones. You mentioned Packard. Tell us what you did at Packard.
So for Packard, we were initially hired for one of their trade shows. Their marketing director had a concept for interactive gauges that would inspire their sales team to reach greater goals. So we created an interactive touchscreen application for them where they could watch the gauges move in real time. It was sort of like a game show in real time on a web screen. And that led to, they liked our online project management system that we use, so that led to implementing a project management system for them, to a public website. This year we did an internet site for them. And returning to the kiosk, their Mexican division liked those so much, they asked us to translate them and build them a copy in Spanish.
So is this with all their products and their parts and whatnot?
This is for the marketing department here out of Renton, but yes, for all their products.
And it was interactive so that they actually could interact with the website and...
Yeah, they would go to the trade shows and they could enter orders and the real-time database would be updated. And then their catalogs are thousands of pages, so just like on a tablet, you could scroll through the pages and then print particular product sales sheets that you wanted.
Sounds like an incredible project.
It was a lot of fun.
So let's shift gears and go back to the mom and pop kind of things, the Daniel Broilers, and you've done some for Schwartz Brothers.
So the key for them is letting them shine in a competitive marketplace. So we did that. Part of it was through the design, making their website unique that way, but also even more importantly, or as importantly, was search engine optimization. More and more, the Google is judging folks by real content they say and by whether or not they're tablet and mobile friendly. So we emphasize that in today's websites to help people be found.
So when you say website optimization, explain what you mean by that.
It's aligning the content with the keywords and the key phrases that folks are more likely to use to search for. And it's making sure that the website has as much of that as possible. So if you're searching for a romantic place to have a steak on the waterfront in Seattle, and there's any number of places you can go for that, their websites and their contents will cause them to be ranked higher than their competitors. And there's both an art and a science to that.
So explain the art to it.
The art is more of the how it's written for that, and the science is looking at the analytics behind it and making sure that the content follows that.
So, and it's the wording, I assume, that is critical.
It's the wording, and it's also having sufficient content. If you're attempting to rank a new restaurant and you have 2 pages of content versus an established one which may have 25 pages of content, on sheer content, the 25-pager will rank higher.
Okay. So, and you're an expert at getting the 2-pager to have a higher rating than the 25. No?
We can't do that.
Oh, okay.
With no magic wand and no inside connection with Larry Page or other folks at Google.
Okay. But you still rate high 2-page compared to 2-page.
Yes, we would align it as best as it can possibly be.
So, with the smaller firms, how do you go about building their website?
We listen to what they're seeking because they know their markets and they know their clients best. And then we combine that with our 17 years of experience to align the design and the content as competitively as we can.
And a lot of firms already have a website. For example, we have a website and we want to update it. We just went through an update. But if we were to build another website or update our website, how would you go about doing that?
We would ask you things like, what are the differentiators between you and your competition? And what are the takeaways that if someone comes to your homepage and they've either searched for you or been referred to you, what are, say, the 3 key takeaways you want them to get in 15 seconds? And then we would design and optimize the writing of those pages to follow that.
Okay. And do you have any set idea, or how do you decide how many pages are involved? What should be the optimum size for a company?
There isn't an optimum size per se, but as a starting point, we ask the clients to take a look at, say, the top 6 to 10 frequently asked questions that a prospective client who you're meeting with would ask, and to make sure that your website answers that. And then it's really the more content is the better for it.
So in a website, a lot of people will log on to a website, look at it a very short period of time, and then move on to some other website. How do you kind of attract attention to have them go beyond just that 10-second glance?
We make sure that the welcome text, so to speak, the 150, 200 words right on your homepage is focused on the terms that you and us believe will be most beneficial, a search engine optimized text, and so that should capture their interest. And maybe you also have a couple of hero images with marketing taglines. So as quickly as possible, you're capturing their interests.
So when you say a marketing tagline, what do you mean by a tagline?
There was a time a few years ago when Dell would sort of allow the consumer and the enterprise groups to self-segregate themselves. So if you came to Dell.com and you were looking for an individual computer, right there on the homepage, there would be a button for you. And if you came from a media-sized company or a large company, there would be buttons for you as well. So right from the homepage, instantly, you would be selecting text and content that's appropriate to you. So we would encourage the small business owner to do the same thing. If you have more than one market that you're trying to target, then right there on the homepage, direct the folks as quickly and efficiently as possible.
So that's a button, but a tagline itself, is that a tagline as well?
Yes.
Okay.
It would be, say you had an animated hero image, and each one cycled for 4 seconds, perhaps. So right there on the homepage, they could say, oh, this relates to what I'm looking for.
So when you say an animated hero, what do you mean?
A lot of websites these days, a very popular thing is to have an edge-to-edge image, and usually, taking the top third, say, of the page, and we call those hero images.
Okay. So this is fascinating. So if someone wanted to get a hold of you and have you go through their process and either update their website or build a new website, how would they do that?
They can go to our website, blueskyprojects.com, and they can email or they can call us.
Okay. And your phone number?
It's 206-721 2550.
That's great. So you do very, very nice work, and you've been doing it for a long time.
Thank you.
Thanks for being on the program.
Thank you for having me.
So I want to shift gears and coming back to this shock, which I believe could be happening this coming year. And I can't say that it's going to have a dramatic impact on the market. I can't say whether it's going to last 1 month or 2 months or 3 months or 4 months or 0 months. But I do believe that there is the potential for a shock that's going to hit a portion of the market and a portion of the industries. And I believe that it's credit related, it's energy related. You know, when you have commodity speculation, as I talked about earlier in the program, where you have over 50% of the commodity contracts that are outstanding are speculative contracts, with the buyer of the contract never having any intention of ever taking possession of the product itself, whether it be oil, whether it be sugar, whether it be steel, whether it be aluminum or gold. When you have that kind of speculative fever, and when that turns, you end up with the pricing coming down. That's commodity speculation. I believe we've really seen that, and we've seen the bubble burst. We've seen a lot of new drilling that's taken place in the oil market. You know, I mentioned that I was getting calls weekly. I was getting a couple calls for a while, every week, of trying to get me to get my clients to invest in these drilling projects, going to conferences and booth after booth having a oil exploration, and the break-even points in those were very high, a lot higher than the current price is. So you had all this going on, and when it comes down, it comes down. We had fracking. It created a lot of overcapacity. And when prices dropped last August, they dropped from over 100 to the price today. And I believe that oil hit a very low price today, the lowest it's been in 6 or 7 or 8 years. It's been a long time in coming. And when you have that kind of situation coming, there's a potential for a shock. And I'm going to explain that shock right after we come back from this break. Don't go away. I'll be right back.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our clients' interests first in all portfolio decisions.
If you're looking for a home for your 7-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
And before I get to the shock, I want to remind you one more time, you can like us on Facebook, you can check our website, and from that website, adamsfinancialconcepts.com, the podcast will be there, the blog will be there. You can read about things even beyond what's on the radio. You can read about and take it even further. And if you have questions, you can ask them on the website, and I will actually answer those questions. Follow us on Twitter at About Money Radio. So what is this shock that I'm talking about? What's going to happen? I've talked about commodities this whole program, talked about oil. And when you look at energy, what's happening right now as the prices have dropped, you have people beginning to feel like things are going to come right back. This is kind of a correction. It's a short-term deal. And if they're right, they're going to do very well. But if they're wrong, we're going to have a shock. So far, as of a couple months ago, $52 billion have been raised in private equity for distressed energy funds. Those are private funds. They're not open to the public. In addition to which, you had purchases by mutual funds of low-priced oil assets. You have purchases by hedge funds. You have individuals who think they're buying something very cheap. If you look at the difference between growth and value stocks, there's a 9% difference between the two. That's really significant. And either they're going to come back up, the value things are going to come back up, or that difference. And I believe that it may not come back up for a while. That difference is going to have an impact. But most of the people that are investing in those funds are expecting a very short-term correction. They think that the drop is short-term, it's temporary. But they're not the only ones. It's not just investors who think that. The Standard & Poor's oil sector has a market cap of only $80 billion. That means if you take the stock price times the number of shares outstanding for all the oil companies, energy-related companies, in the Standard & Poor's 400, the oil sector is only $80 billion. The funds raised, the private equity funds, distressed energy funds have raised at least $52 billion, not counting mutual funds and hedge funds and individuals. The sector is only $80 billion. But you know what's the most interesting thing of all? Is that the Standard & Poor's Mid-Cap Energy Index has shown assets of those companies are increasing. They're at record highs today. They're at much higher levels today than they were in August of last year. That means, in my opinion, they're carrying their reserves, they're carrying their inventories at $100 plus oil prices. That's very, very significant. With oil trading today at $40, they're carrying their inventory and their reserves and the oil which they have rights to at $100 a barrel. That's my guess of what's going on. And what that means is this coming spring, when they go through their audits, their auditors are going to ask them to mark to market. That means they're going to have them write down their reserves from $100 to $40. I think that's the potential shock that's coming. For some companies, what that means, it's going to put them in violation of their loan covenants and their bond covenants. They're going to default, essentially, on their bonds and their loans. For some companies, it means they'll file for Chapter 11, and for some, maybe even 7. Now, I haven't heard anybody talk about this at all. So I could be completely wrong. I could be completely dead wrong. But to me, it makes sense. And it means if that actually happens, it could mean a big shock to the market. Now, that happens only in a few industries. And I believe this difference between value and growth is telling us that if people haven't completely figured it out, that they're beginning to wonder about it anyway. I think that that's the shock that's going to happen. But at the same time, you have a lot of other industries that are growth industries that are benefiting. We're seeing the super cycle happen. And yes, growth is slowing down worldwide, but it's growing. And many countries who depend upon commodities are seeing things hit close to a bottom, or maybe they're going to bottom out, but it's going to be, and we had an example with the housing market. Oh, what happens? Prices get down to a level, and then they begin to come back. And we're going to see that the worldwide economic GDP growth is going to continue to grow it's just going to take the commodities type companies time to figure out. And yeah, companies are shutting down plants. They're trying to get supply back in line with demand. And as that happens, it will start to push up prices. And some of those companies are going to survive. But it doesn't mean it's not going to be a shock. We could very well see a correction of 1 or 2 or 3 or 4 months, or maybe nothing. Maybe the general investors are going to look at this and let it just go by, because oftentimes in a bull market, bad news is ignored. And in a bear market, good news is ignored. That's just a rule of what happens. So it could just go by easily. But I do think that there's going to be a significant fallout with that. I think there's one other potential shock that we need to talk about, and we've just got a couple minutes left, and that's the unicorn level. There are now 142 unicorns. It used to be that if a company had a private valuation of $1 billion, it was so rare, so indeedly rare, that it was called a unicorn. Unbelievable. Fairy tale. Today we have 142. That's 3 times the number that we had in 2013. Private equity and wealthy investors are the only ones that can really invest. You have to have some sort of connection and a lot of money. And they don't come under the same scrutiny as public companies do. And we just have Theranos, a company which is really beginning to feel the pressure of maybe things that they've been saying are not exactly the way they really are. Theranos does a blood test. With a few drops of blood, they can get the same results as those blood draws, where they take, a gallon of blood each time. Actually, I'm exaggerating, but where they take a lot of blood out of a vein. Theranos can do it with a couple drops of blood. It just received a $400 million infusion of capital, which ranks the company at $9 billion worth. Elizabeth Holmes, 31 years old, dropped out of Stanford 12 years ago to start this company, is considered the youngest self-made billionaire ever, 31 years old. But there's some real questions. Wall Street Journal raised the questions. GlaxoSmithKline, who she says they had and were doing tests with, said they haven't done anything for 2 years. Quest Diagnostics, by comparison, has a profit of $600 million, $7.4 billion valuation, less than Theranos. And Theranos may be one of those which caves in. We'll talk more about that in the coming weeks. Don't delay. Go to the website. We've got more on the website. We're going to talk about Theranos on the website. We're going to talk about the shock on the website. Those are going to be blogs. Pick them up on the website. And if you have questions, ask them there. And until next week, have a very wonderful weekend and week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on AdamsFinancialConcepts.com. That's AdamsFinancialConcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.